Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN AM for Monday, September 14th, 2020. And our top stories today, we'll get a post-summer economic and markets update. And then what does the new Federal Reserve policy mean for investors? Well, joining me now to discuss this and more is Dr. David Kelly. He's the Chief Global Strategist for JP Morgan Asset Management. David, thanks so much for joining us on the program this morning.
Glad to be here, Jeff.
It's great to see you. I hope you all are staying very safe up in your neck of the woods. Last time we chatted about 3 months ago, we were kind of in the midst of this pandemic, and we're still in the pandemic, but here we are into September, and I wanted to get your assessment of where we are today and where we've been.
Well, we're doing a little bit better than we were doing a month or two ago, so that's good news. The number of cases has fallen from there, but of course it's higher than it was even at its peak in April. And the reality is that we're not, we haven't abandoned all restraint here, and so the virus is not spreading as fast as it would do if we did that. But still, it's significant enough to really have a big impact on everybody's lives. And on the economy. We've sort of settled into this grim equilibrium of almost 1,000 people dying every day, and that is a sober enough number to cause us all to maintain social distance and not really want to get into crowded planes or restaurants or hotels. But at the same time, it doesn't seem to be quite dire enough to cause everybody to behave responsibly, and so unfortunately, we're not entirely united in dealing with it, and so it just continues to sort of slowly spread relative to what it could do. But I think that will continue until we have a vaccine, and hopefully next year we can approach this in a more united way with a vaccine and try to crush the virus and really, get back to normal. I think that will happen, but it will be in 2021.
Yeah, I think fingers are crossed, and I think people, obviously heed what public health officials are saying, and that is stay socially distant and wear your mask. Dr. Kelly, we've had an up and down in the stock market this year. Clearly, I seem to recall the Dow Jones Industrial Average dropping from its high of 29,000 down to around 19. I'm not using exact figures, but somewhere around there. And it's climbed back over the past 6 months. I know there's still volatility, but what do you make of that? I mean, are we strong, in your opinion, just looking at the fundamentals economically? How do we look?
Well, yeah, I think it's very important to get the economics right first, and then we'll go into the market. So on the economics, what we have is we don't have a full V-shaped recovery. What we have is what I'd call a V-interrupted recovery. The first part of the recovery was, after the shutdown in April, a lot of businesses have adapted and people have gotten back to work. And businesses, you can basically get back to work. So things like home building, home buying, car sales, manufacturing, a lot of these things are back to normal almost, and there are a lot of other businesses like our own, frankly, where you can really operate in a remote way pretty effectively. And so that's caused the economy to bounce back. But I think the best way to look at this is in terms of jobs. Between February and April, we lost 21 million jobs, and we have now regained 10.5 million jobs, which is 48% of the jobs that we lost. But getting the other 52% back is going to be tougher. It's kind of like a marathon. I don't know if you've ever run a marathon, but I'm going to try my 4th marathon this weekend as a virtual marathon.
I saw that.
Well, one thing I can tell you from previous marathons is the second half is always slower than the first, and that's going to be true of this recovery. We've bounced back nicely to this point, but from here on out, I would expect an average of no more than 1 million jobs a month being added, and that number will probably be declining. So it's going to take us all the way into later on next year before we even get back to where we were in terms of GDP, and maybe into 2022 before we get back to where we were in terms of jobs. So it's going to be slower from here. And then I think you have to ask really the question, is the market really factoring that in?
So I'm going to ask you, you asked yourself the question, I'm going to ask you the question, is the market really factoring that in? What do you make of markets? A lot of volatility. I just, as an outsider looking in, I see this run up to close to where the highs were this year of all time. It's unbelievable given all these headwinds.
Well, there's the stuff that you can rationalize and the stuff that you can only irrationalize. So let me rationalize what we can.
Sure.
It's true that this that the stock market should not have been hit as badly in this recession as in the great financial crisis. And I'll give you 3 reasons for that. The first is that this is very much a book-ended recession. It starts with a virus, it ends with a vaccine. It's probably a 2-year experience all told. And after that, earnings should really be back on the track they were on back in 2019. Now, if you think about a stock is the longest lived of assets. Its value comes from a growing stream of cash flows going years and decades into the future. And if what you're saying is that 2 of these years at the start are pretty lousy, but then it gets going again back to normal, most of the stock market should have been protected. Most of the value is still there. That's one thing. Then the second thing is that, as we know, the most important sectors to the stock market have not been that badly affected by COVID-19. You think about things like technology, healthcare, you've actually got extra demand there. Consumer staples, extra demand. I think financials is more complicated, but still it can operate in this environment. And so even though this is tremendously painful for society and very painful for the economy, it's not as bad for the stock market. And then the third thing supporting the stock market are just these really low rates all over the place. Corporate bonds, government bonds, high yield bonds, municipal bonds, all of it very low interest rates. And that is just funneling money towards the stock market. So that's the part that you can rationalize. The part that I think you can only irrationalize, to coin a non-existent word, the part that you can irrationalize is the market going above, hitting new all-time highs, going to PE ratios which are well above long-term averages, given the uncertainty out there. And there's a lot of uncertainty out there. And I think what's really going on is, in some ways our financial markets are almost as polarized as our politics. They're just 2 camps. So those who are hiding out in cash, in government bonds, very safe assets, but there's a lot of money still looking for growth, momentum, and just latching onto whatever looks like it's doing well. And I think they probably have pushed at least some mega cap growth stocks too high at this point.
You mentioned tech stocks, and when we do, well, we're going to get back to some level of normalcy. I don't know exactly what it's going to look like. And tech stocks, clearly, the Zooms, we're doing things virtually. Yeah. Do you ever see a point, if we get back to seeing each other personally, we go back to an office, do you think that some of the run-up, some of the positivity that has impacted the tech market kind of recedes a little bit because we'll be back to semi-normal behavior?
Well, there are about 3 parts of this. First of all, in terms of behavior, I think there are some parts of behavior that will be permanently changed. And it was a change that was happening slowly over time, but this really forced everybody to adopt new technology. So exactly what we're doing right now in terms of Zoom technology, I think that is a permanent change, and that will affect business in the long run. I don't think you're going to need as much office space in the long run. I don't think you're going to see as much business travel in the long run, because all of it can now be done more efficiently, teleconferencing. What you really needed was everybody to get used to and comfortable with doing that. I think that has happened. So I think that part is permanent. But part of it, the part that's not permanent is consumer behavior, household behavior, personal behavior, because I am dying to go to a football game. I really want to Fenway Frank. I would love to go back to Broadway. And as soon as I can buy an airline ticket safely, I will do so. And I think there's a lot of demand to get back to the normal social interaction that we as humans like to do. And so I think that we will see that resume. But then when you get to the whole issue of stocks, you still have to look at these company by company and ask yourself, does this company have such a unique advantage that it is going to build basically a fence around its cash flows going forward, that nobody can replicate what they're doing in terms of providing a service? And I have real doubts about that. I mean, there are businesses with high margins and perhaps who can do that, but there are a lot of businesses which will take a temporary advantage because everybody adopts their technology, but then somebody comes up with some cheaper version of doing the same thing, and suddenly their margins get eroded. And I think in a slow-growing U.S. economy in the long run, I think you may see some of these mega ideas come to earth, because it's very hard to find something that's truly a natural monopoly, which is going to have very high margins in the long run.
Yeah, well, it's certainly going to be interesting to watch. Well, Dr. Kelly, I want to take a quick break. When we come back, we're going to talk to David about the Federal Reserve and Federal Reserve policy. What's it mean for you? You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
The windows on our homes, they protect us and the ones we love, but they do much more. At Renewal by Andersen, making your home more comfortable is at the center of every window we make. It's why we custom build our windows in America and install them in as little as 1 day. It's why we build our frames with exclusive Fibrex composite material that's 2 times stronger than vinyl. It's why our glass helps keep your home warmer in winter, cooler in summer, and quieter all year long. It's why we stand behind every window with a 20-year limited warranty. Why not help lower your energy costs while giving your home and family the best? Call 1-800-835-6525 to schedule a free in-home consultation. Buy one, get one at 40% off with this special offer. Plus, get special financing with no money down, no monthly payments, and no interest for 1 full year. Renewal by Andersen, the better way to a better window. Call 1-800-835-6525 now.
Welcome back. We're talking to Dr. David Kelly. He's the Chief Global Strategist for JP Morgan Asset Management. Dr. Kelly, thanks so much for staying with us this morning.
I'm very glad to be here.
It's great talking to you about the economy, about markets. Now I want to focus on the Federal Reserve because we had some very interesting comments from Chairman Powell recently about policy, central banking policy going forward. Can you break it down for us?
Yes, well, I think there are really 2 things going on at the same time with Federal Reserve policy, which are both very interesting. The first is that since this pandemic started, the Federal Reserve has adopted some very extreme, what they would call QE or quantitative easing. But really what that means is they're building up their balance sheet. And the way they're doing that is they're buying treasury bonds in massive quantities on the open market. In fact, since the start of the year, they've bought $2.2 trillion worth of treasury bonds, and they're adding about $1 trillion per year to that. Now, why is that so important? Because guess who, who's supplying those? The US Treasury is. Well, what we're seeing is massive government budget deficits, which are essentially being monetized or financed by the Federal Reserve. Fast and all as Steve Mnuchin is printing new bonds, Jay Powell is buying them up. Now, if monetary policy itself is not particularly powerful at promoting economic growth, people don't really care about what low long-term interest rates are really when it comes to business decisions. But if you use these low long-term rates and if you use all this Fed power to buy bonds to enable the federal government to have massive tax cuts, one-time checks to individuals, higher unemployment benefits, more infrastructure spending. If you do all of that, then you can generate more economic growth and more inflation. So monetary policy has suddenly become much more powerful because it's being used as a tool really to finance very expansionary fiscal policy. That's one thing they're doing. A second thing that I think is really interesting is the Fed's adoption of average inflation targeting. Now, the idea is this, in the long run, and for many years, they've had a target of hitting 2% inflation as measured by something called the personal consumption deflator. That's what they wanted to get to. But for years, they've actually seen an inflation rate come in below that target. And so inflation's always been lower than the Fed said it was going to be. And one of the effects of that is it's lowered people's expectations. People don't really expect high inflation. And for various reasons, it's a good idea. The Fed finds it useful if people expect somewhat higher inflation. So they're really focused on, well, how do we get people to expect more inflation? And their bright idea is, well, what we'll do is if we run below for a few years, what we'll try and do is run above that target for a few years. So on average, it looks like we're kind of hitting 2%. Now, personally, I don't think that's a very good idea. I mean, it's kind of like if you go around all winter in a t-shirt, you decide you're going to wear a heavy sweater in the summer, and I think that we will end up with higher inflation because of this. But it really is a very expansionary policy. If you think back over the years, it used to be that central bankers tried to raise interest rates before inflation became a problem. I remember central bankers used to say, I'm going to take away the punch bowl before the party gets out of hand. Then under people like Ben Bernanke and Janet Yellen, they were data dependent. Okay, as soon as we see the whites of the eyes of inflation, then we'll raise rates, but not before. Now under Jay Powell, this policy of average inflation targeting is we're going to let inflation in the door, is going to be playing around. Inflation is going to be above where we want it to be before we even react. And so it's a very dovish policy, and it's a dangerous policy because, of course, inflation could begin to get too high then. And the only way the Federal Reserve can control it is by pushing up interest rates. But if they push up interest rates, think about all that government debt that's being financed now at very low interest rates. You've got to finance that at higher interest rates. You've got some fiscal problems. So I think it's a dangerous combination, which will lead to higher inflation, but potentially real fiscal problems in the middle of this decade.
David, what does this mean for those of us who are saving for retirement, those of us who are near retirement, maybe they were 5, 10 years out? Is there anything that we should be thinking about? I'm 20 years from retirement, give or take. But I mean, how does this change the long-term investing, or does it change the long-term investing outlook?
Well, it makes it more uncertain. It means you got to think more about what you're doing here. I think this is a market of extremes in terms of very high valuations for large cap growth stocks, and frankly, very high valuations for also things like long-term bonds because the yields are so low. But there is a boring middle in capital markets, which I think is being ignored. US value stocks are actually priced perfectly normally, particularly if you expect that the economy is going to recover. And international stocks, both emerging market stocks and developed country international stocks, are about as cheap relative to US stocks as they've been at any time in the last 20 years. And so I think I think what people should do is have the discipline to be diversified. I know it's tempting either to get very scared or very, very greedy here, but what people need to be is balanced, have that diversified portfolio. I think you should protect against inflation, make sure you own a home if you can, have some real assets, but also invest in things that make sense from a valuation perspective. These are unprecedented times, but you still got to think your way through them in order to make good investment decisions. I think that's why people need good financial advice, but it's also a time when people really need to be very disciplined in how they think about things rather than getting carried away with the positive or negative emotion of markets.
Yeah, it's tough to set aside those emotions. Last question, David. Obviously, this is an election year. The full House, a third of the Senate, and obviously the presidency. How does that factor into markets? What does that mean longer term?
Well, it is very important. I mean, I think I always tell people, don't let how you feel about politics overrule how you think about investing. I think there are a lot of people. A lot of Republicans wouldn't invest during Obama's term in office and the market went up, and a lot of Democrats wouldn't invest when Donald Trump was in office and the market went up. So I think that's the first point I'd make. Second of all, with regard to the election itself, the truth is it's too early to know. At the moment, Joe Biden has a lead over Donald Trump, but we're still 8 weeks away or 7 weeks away from the election. It's too early to tell. And then the other thing is, even if we knew how the election was going to turn out, recent experience says that, even given the result, the market's behaved in an odd way and in an unpredictable way. So I wouldn't make too many bets here. The one thing I would say is that there are 3 possible outcomes. You could have a Republican sweep, you could have a Democratic sweep, or you can have a Democratic president with a Republican Congress. What you won't have is Donald Trump getting reelected and the Congress remaining in Democratic hands. So if Donald Trump is reelected, he's going to be in a very powerful position. I think if Joe Biden is elected with a Democratic sweep, that will also be a powerful position. In both cases, I think you'd see an expansionary fiscal policy. But if you have divided government, then I think you will see a pullback and more gridlock in terms of fiscal policy, and that could actually lead to a slower economy and a slower recovery in 21 or 22 than we expect under a sweep in either direction.
Yeah, really interesting analysis. Dr. Kelly, thanks so much for joining us on the program this morning. And look, we'll have to keep tabs as the market changes and as politics changes and the economy changes. We'll come back to you for more analysis. Thanks so much. Have a great rest of your day.
You too, Jeff.
And that wraps up this episode of BRN AM. Have a topic of interest or someone you think we should talk to? Drop us a line. And don't forget, for all the news in retirement, markets, technology, personal finance, and more, all in one place, check out our newsletter, The Morning Pulse. So until tomorrow, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Are you being audited and do you owe the IRS $10,000 or more in back taxes? Is the IRS threatening to take more of your money? Don't fight the IRS alone. The Tax Doctor is here to help you negotiate your tax bill and reduce your stress. The IRS can freeze your assets and seize your bank accounts, but you can stop these IRS actions. The Tax Doctor will work with you using our years of experience to represent your case to help you get the best resolution under the IRS guidelines. Help is here to deal with the IRS to reduce your stress. We've handled thousands of cases, so we know what we're doing. If you owe $10,000 or more in back taxes, do not call the IRS alone. Call a Tax Doctor now for a tax emergency analysis.
Call 800-224-6439.